This voice is taken from an article with the title, How to Manage Risk When Trading Long-Term Trends, which has been published on TraderTalks.net. When trading long-term trends, it is important to manage the risk associated with the trades. The key to successful risk management is to understand the underlying trend and the risks associated with each trade. The first step in risk management is to understand the trend. In a long-term trend, the overall trend is typically more stable than in a short-term trend. This means that the trend is more likely to remain in place for a longer period of time, making it easier to identify and follow. It is important to analyze the trend using various technical indicators, such as support and resistance levels and moving averages, to identify potential reversals and ensure the trend is likely to remain in place. The second step in risk management is to understand the risk associated with each trade. This includes understanding the potential losses and gains associated with each trade. For long-term trades, the risk is typically lower than for short-term trades, as the trend is more likely to remain in place. However, it is important to assess the potential risk of each trade to ensure the risk is acceptable. The third step in risk management is to set an appropriate stop loss. A stop loss is a predetermined price at which a trade will be exited if the market moves against it. Setting an appropriate stop loss will help to limit any losses in the event that the trend reverses. It is important to set a stop loss that is below the entry price and not too close to it, as this will limit the potential losses if the trend reverses. The fourth step in risk management is to use a trailing stop loss. A trailing stop loss is a stop loss that automatically moves with the market as it moves in the direction of the trend. This allows the trader to lock in profits as the trend progresses and limit losses if the trend reverses. Finally, it is important to use proper money management and position sizing when trading long-term trends. Proper money management ensures that the risk of each trade is kept to a minimum and the potential profits are maximized. Position sizing helps to ensure that the total risk is divided among the trades, making it easier to manage. By understanding the underlying trend, assessing the risk associated with each trade, setting an appropriate stop loss, using a trailing stop loss, and using proper money management and position sizing, traders can successfully manage the risk associated with long-term trend trading.